Hello, Business 330 students. This is Professor Hassey. This is our Week 5 weekend update. Our subject this week is capital valuation and capital budgeting, and we're going to address 3 issues in this weekend update video as we conclude Week 5 of our session here at the University of Laverne. We're going to review Assignment 3. Those grades have been posted, and you have now another grade in your grade center for Blackboard. We have 2 grades remaining, Assignment 4 and your final examination. We will also review that capital budget analysis spreadsheet that I gave you in the beginning of the week to see if you could put together. I will review that step by step because you'll be doing something very similar to that in Assignment 4. And speaking of Assignment 4 has now been posted to Blackboard. You have 2 weeks to do it. It's due on Sunday, October 8th. It's a combination of a spreadsheet analysis and a written interpretation of your findings. And I'll go over that in our Week 6 lecture video during as we begin Week 6 next week. I will review that Assignment 4. But you can go ahead and look at it, begin to put it together. There's basically 3 main things you have to do in that. First of all, determine the cost of capital, where in the spreadsheet analysis that I'm doing with this video, the cost of capital was given to you. In this one, Assignment 4, you have to calculate the cost of capital. Then you will be putting together the investment return analysis, and then you'll be doing some written work, 1 to 3 pages of what that analysis tells you. Remember, we're concentrating these 2 weeks, Weeks 5 and 6, on 5 chapters: investment criteria, discounted cash flow, which we looked at in Week 5, project analysis, cost of capital, and risk and return in capital budgeting, which we'll do in our lecture video for Week 6. So let's take a quick look at Assignment 3 and what I was looking for with that work. The grades have been posted, and basically the work was doing some multiple choice definitions of stocks and bonds, and then some calculations, especially some research in what stocks and bonds tell us in the market. Number 1, what is the 10-year United States Treasury yield, and what does that represent? And number 2, what does a stock page giving stock information in the market, what are all those indicators tell us about a company's stock position, and what it tells financial managers and what it tells investors? So a couple of key areas where some of us had some issues, and it was in questions 1 and 2. In question part 2, remember question 1 and 2 is worth 20 points, basically 10 points apiece. Question part 2 is on stocks, and that was worth 30 points. Again, 10 points apiece for each multiple choice. Basically, some of us had a little bit of difficulty in number 1. If an investor expects a 14% return, the stock is $50 and the dividend is $2.50. Well, the dividend $2.50 of $50 is 5%. So if they're getting a yield of 5% and they want a return of 14, that means the capital gain rate must be 9%, because as indicated down here in question 3, the expected return on a stock is the combination of the capital gain rate and the dividend yield. And then we had 50 points for part 3, 50 points of telling me about, first of all, the United States Treasury yield as of Friday, September 15th. Now, I went by the Wall Street Journal on Saturday, which at the close of the market said the real yield on Friday was 4.321%. If you had 4.3, 4.32, something in that ballpark, I didn't take any points away. But if you were off a little bit, I did take 1 or 2 points off. What does this yield of 4.321% represent to an investor? Well, on a $1,000 par value bond, you would be receiving $43.21 annually. As the yield increases, the cost of the borrowing in the market increases as well. That's what that risk-free interest rate tells you. That's the baseline of all borrowing of money. And so what I wanted to see is that this yield sets the standard or sets the benchmark for all borrowing in the market. And that's what I was looking for in question 2. Question 3, we had to go through, and this was an older interpretation of on Yahoo of FedEx Corporation. I didn't want to give an up-to-date one, but I wanted you to go through each one of these lines in this analysis of a stock and tell me what they are. And everybody did very good on this, but the one area where many people was marked off on was right here. PE ratio, TTM, earnings per share, TTM. I took points off if you didn't tell me what TTM is. Trailing 12 months. All right. Where a beta calculation is by quarter, market cap is on an individual day, but the PE ratio trailing 12 months just goes back to preceding 12 months. And same with the earnings per share. Many of you defined earnings per share, but you didn't tell me what the TTM was, and thus I took some points off. So that was how I graded that pretty simply. We all did pretty good. Some of us forgot to do all of the indicated materials. So that's make sure when you do these assignments, you look and make sure you answer all the appropriate questions that I asked, especially when we get into assignment 4 and the final examination. Read each work closely. So those grades are now posted. The solution file has been returned to you with my notes. And now you know where you stand in this class through basically halfway through the class, or 55% of your grade has been posted. 2 more postings. Assignment 4, 20%, and the final examination, 25% of your course grade. Now let's take a look at this capital budget analysis that we began to talk about at the beginning of this week. And I gave you this template, which I would wanted you to fill in and determine the net cash flow and so on. So I'm going to walk through this because again, you'll be given these variables somewhat in assignment 4, and you can see that as you look at that work that has now been posted, and you need to be recreating this for assignment 4. Now the main difference between this practice and assignment 4 is this is a 10-year depreciable life project. Assignment 4 is a 5-year depreciable life project. But the bottom line is to determine the outlay of dollars in year 0, called the investment, the yearly cash flow generated by revenue, expenses, and non-cash items like salvage value, depreciation, working capital. Putting all that together and then determining based on the cost of capital, determine the discounted cash flow, which will lead into the net present value or return in dollars. You can determine the internal rate of return, which is a return in percent. You can determine the profitability index, which is a return in ratio, and a determination of payback in years, which is in time. We practiced all those earlier this week, number 5. So I started the project, this problem, as you remember last beginning of the week, with an investment of $1 million and yearly sales of in the first year of 500,000, which was 25,000 units at a selling price of $20. But now I'm going to increase that by how much? The inflation rate for this is 2.5%. So I'm going to take 500,000 and multiply it times 1.025. That's adding 2.5% to that number, and I get 512,000. And now I'm just going to grab the corner of the cell and slide it all the way to year 10. And there's my total revenue generated off this investment of $1 million inflating at 2.5% a year. Then I get into my expenses. And expenses in this analysis now, beginning with this capital budgeting analysis, breaks our expenses into three areas, really four areas. Variable cost per unit, fixed cost, which is a total dollar amount, depreciation, and then our income tax. So variable cost, as we mentioned at the beginning of the week, was 25,000 units. That's how many we were producing at a variable cost rate of $8. That's $200,000. There's the formula right there. Now, just like I did with sales, I'm going to increase this 200,000 by the inflation rate for variable costs, which is given as 2%, 1.02. And there's my new variable cost rate. And now I'm going to slide that all the way to year 10. And there's my total of my variable cost. Fixed cost is a flat amount, not based on output or volume, just a flat 50,000, but also that it does inflate at 1% a year times 1.01. Oops, back there. Times 1.01. And there's a 1% increase, and that's going to slide all the way to year 10. And there's my total fixed expenses inflating at 1% a year. Depreciation is always going to be 100,000. Notice I'm fully depreciating. I'm fully depreciating this over its life. In other words, it's a $1 million asset cost. I'm depreciating it $100,000 over 10 years. That means I'm fully depreciating the $1 million investment over time. Then I take, as we began last week, I take my earnings before taxes, which is sales minus the three expenses, which in the year one was 150,000. Now I'm going to slide that all the way across to year 10, and there's my earnings before taxes. Then I'm going to take 45,000 or 30% of that number to get my taxes that I'm paying on that earnings before taxes. So now I just take that number and slide it all the way over. And there's my income taxes paid every year, 30% of my earnings before taxes. This is why spreadsheets are so nice. You can, once you do the original formula, you can just copy it down the multiple years that you're using. Thus, now we have our net income off this project, which is earning before taxes, minus the tax we paid on that profit. And there's our net income over the life of the 10 years. But in addition to that, we have to add back in or subtract out certain things that also involve cash flow. One is the salvage value. Notice they tell us in this problem in year 10, we receive $50,000 salvage. Okay, that's great. But remember, we've fully depreciated the asset, so it has a zero value. Cost 1 million, expense 1 million over 10 years. So on our books, it has a zero value. Now we're getting $50,000 on that, so that's considered a gain on a disposal. So the $50,000 will have to be equals 50,000 times 1 minus the tax rate of 30%. In other words, we have to pay tax on that gain. Thus, whatever's left over, or 70%, is $35,000. So yes, we get a salvage value in year 10, but it's not 50,000. We have to tax that as gain. Thus, we now have 35,000 as our capital salvage value net, including taxes at the end of its life. So 35,000 in year 10 there. Then we add back in depreciation. We talked about that earlier in the week. And now we calculate the most puzzling for a lot of students, working capital. Working capital is a percent of the next year's sales. So it's a rolling amount, meaning it's going to be 12% of whatever the next year's sales is. So in year zero, 12% of the first year's sales of 500,000, that's obvious, $60,000. But now we have to add an additional working capital outlay because our revenue in year 2 goes up by $12,500. So I'm going to put in here a formula equals year 2 sales minus year 1 sales. Let's put that in parentheses to isolate that expression. And then we're going to multiply that times minus 0.12, which, excuse me, 0.1. That's our working capital rate is 12%, and we get $1,500 negative. In other words, now at the end of year 1, we have $61,500 allocated in cash to going out to maintain 12% of 512,500. And now we'll just do that expression all the way to year 9. In other words, we're expending additional cash because our revenue is increasing, thus the need for additional working capital. But then in year 10, there's no more. The project is over, so there's no more need for working capital. So in year 10, we just take equals year 10 sales times 0.12, and we get $74,932 of positive cash flow. Why? Because if you take from year 0 to year 9, that's $74,932 of cash going out. With no more need for working capital, we add all that back in year 10. Thus, the net is 0. Just a quick note is your working capital at the end of every project should total sum to 0. You're going to have these negative numbers in the years because revenue is increasing, thus your demand for working capital. But then at the end of its life, when there's no more use of this, as far as calculating is concerned or budget analysis, then we have to add it all back in to zero it out. And there we go. So now we have created, just like we did in Chapter 9, a net cash flow for every year generating from this investment of $1,060,000. $1 million of the asset purchase, the equipment cost, and the working capital requirement of $60,000, 12% of the first year's sales. So that's a total cash flow generated off this of $2,417,045. That's a lot of money. Well, let's see if that's going to equate to return looking at our 4 different methods. First of all, what's the discounted cash flow of this $2,004,000 at a cost of capital or a project WACC of 8.83%, which is given in this problem? In assignment 4, you'll be calculating this number, thus the subject of my video in week 6. So if I do the discounted cash flow analysis, formula, function, financial, and I look for the NPV, the net present value function, and I type in my cost of capital given is 8.83%. And now I go to value, and I go to the value of year 1 through year 10, F21 to O21. And now that's going to sum up, taking that $2,004,000 and discounting it back at my cost of money, 8.83%, and I get $1,510,832. The net present value is the difference between your discounted cash flow and your investment in year 0. $450,832. Pretty good return. Our internal rate of return is, what is this return in a percentage? Formula, function, financial, IRR. There it is right there. Remember, we did this earlier this week in those 2 problems. Internal rate of return is just one calculation including year 0 as your beginning value all the way to year 10 of your net cash flows. So that's E21 to O21, and that converts that into a percentage. and we go to 2 decimal points. So 17.03% is our internal rate of return. So we're generating a return of a little bit over 17% on a cost of a little bit under 9%. Thus why we have the profit. Pretty good. Our profitability index is the ratio of the discounted cash flow to the investment, and I put that investment in a minus number to wipe out that negative, and I get 1.43 ratio. So in other words, the discounted cash flow is 1.43 times greater than the investment in year 0. That's the ratio. And then the payback is a little bit more arithmetic. How many years do we get back our $1,060,000? Well, in year 1, if I take 1,060,000 and add to it the year 1 cash flow, at the end of year 1, I have 856.5 less to be paid back. I take that number, 856.5, and add into it the year 2 cash flow. I'm down to 647. So let's just take that out over a few years. And as you can see, by year 5, we have now paid back the $1,060,000. 1, 2, 3, 4, and part of year 5. What part is that? Well, we just take equals. We take the remaining balance at the end of year 4 and divide it by the year 5 cash flow. What percentage of that is that? And we find it's 0.94. So 1, 2, 3, 4.94 years is the payback. So that's pretty good. So that's what I was looking for. I'm going to save this because I'm going to post this to Blackboard. So that's what it entails of doing a capital budget analysis. The only difference between this and assignment 4 is in assignment 4, you have to calculate this number here, WACC, and you're given these variables, but not nice and neat. You have to figure them out, implant them in a template that I provide you with you in the assignment, and then you create the spreadsheet, including you have to do all the formulas and calculations. Those won't be given to you like they were in this practice one that I gave you earlier in week 5. So if you put this together and it looks pretty good, or if you haven't put it together yet, try doing it using this as your answer sheet. And this is a perfect template to use for your assignment 4 work, which I give you the template, but you'll know how to set it up because of looking at this. So that's the analysis called capital budget analysis. It's taking the variables that you expect to incur off this project at the dollars you're investing in, at the growth and revenue and expenses that you're planning, including salvage value, depreciation, and working capital, and determining the investment criteria to tell you, in this case, this looks like a go project. We're making a good return on our investment. Now, if I work for a company that expected 20, 25% return after my investment, then this would not be a go. It's how you interpret it in the culture of the business, or how you personally interpret it in the culture of your own business financial management. And that's the question I'll be asking you in the written portion in assignment 4, and we'll talk more about that in week 6. So that's the answer for the handout or the practice problem I gave you for week 5. Now here's assignment 4, which I posted on today, Sunday, that you can begin to review and look at. Now, again, some of it you might need my lecture video for week 6, but others of you maybe can begin the process of this. But you can't do anything until you determine the cost of capital, and that's what you have to calculate in this problem. But let's take a look at the overall view of the assignment, and then you can chew on it and look at it as we begin week 6. This work is due on Sunday, October 8th. 2 files to be posted for this assignment. You need to post 2 files for this work to Blackboard on October 8th. One is the spreadsheet file, of which I give you a template that is provided. 2 is a Word or a PDF file interpreting the analysis. So 2 files need to be posted. This work represents 20% of your grade. The first question is to do the capital budget analysis. Based on the inputs below, prepare a capital budget analysis for this base case using net present value, internal rate of return, profitability index, and payback in years methods, determining whether the project is feasible. The weighted average cost of capital also needs to be determined to complete this analysis. And I've provided you a spreadsheet to do that. Let's take a look at what that spreadsheet looks like. Okay, here's the spreadsheet for assignment 4 that you have to fill out both tabs. The first tab is to determine the weighted average cost of capital. What is the cost of debt? I should fix that. It should say, what is the after-tax cost of debt? There we go. And the cost of equity. And then combining those two based on the weight of the capital structure of the company, what is the weighted average cost of capital? Again, this is part of our discussion lecture. In week 6, we will go over this process. Once you determine that cost of capital, then you can put together the capital budget analysis. And notice I got it all set up for you, but you have to do a few things. Number 1, you have to take all the variables and interpret those variables and put them in these appropriate sections. Then using these variables, fill in the entire cash flow sheet. Then you do your investment criteria calculations based on that information. All right, that's the template that you will be turning in and filling out for assignment 4. So you do 2 tabs within this file. Determine the weighted average cost of capital, place that weighted average cost of capital here, fill in the other variables, and then do your analysis. All right, that's the assignment for the first question. So what we just saw was the template to do question number 1. Here are the inputs to determine the cost of capital. Here are the variables to determine the capital budget analysis. You are to interpret these and put them into the spreadsheet. Not like the practice one we did this week where I had those all set up for you. You have to determine that, but that's why we did the practice, so you could get used to that. The second question is too quick on the trigger here. There we go. The second question, remember, this is a spreadsheet, question 1. The second question is the Word or PDF document where I ask you in a written analysis, which should be double spaced, 1 page minimum. And I do mean 1 page, not a half a page, not 3/4 of a page, 1 page, and a 3-page maximum. So you can go more up to 3 pages. That's all you need to answer these 3 issues. The issues to address in your written interpretation, please explain the cost of capital as a variable in your analysis. What is the cost of capital? Why is it a variable in your analysis? Number 2, would you recommend this project and why? If you do not recommend, why not? What are the key factors in your recommendation? Number 3, going forward, what adjustments would you recommend to make this project produce a greater return? What would you do to make more money out of this project? What are the various things you would address to make more money out of this project? That's the written section of assignment 4. That is a second file you need to post to Blackboard. It should be a Word or a PDF format. This is now posted to Blackboard for you to download and begin. We will talk about this work also in our week 6 classes. Okay, that's our weekend update video for week 5. A review of assignment 3, a review of the spreadsheet that we used as practice in week 5, which gives you a good idea what I'm looking for in assignment 4. Assignment 4 is now posted for you able to download and begin your work on it as you see fit. It's a double posting assignment, one spreadsheet file, which is provided for you that you fill in, and a written file of your interpretations of the information you put together. That's our week number 6, and we'll do that in our lecture video and our in-class lecture for week 6 to go over all these. Again, these are the chapters that we're reviewing. Chapter 8, 9, 10, 11, and 12. 10, 11, and 12 this week in week 6 will be the subject of our discussion. Have a great rest of the weekend, everybody. Double check your grades through this course up to this point. Let me know if you have any issues or problems, and we'll go forward in our last 4 weeks now of our course. We'll see you week 6. Adios.